Equity Market Update, August 2019. In August 2019, Indian equity markets were largely range-bound and ended the month 1% lower. The developments like escalating trade tensions between US and China, FII outflows, measures announced by the central government to support economy dominated the market movements during the month. Mid-cap and small-cap indices corrected more than large caps and continued to underperform large caps during FYTD20. Sectoral indices performance was mixed, with IT, auto, healthcare being the best performing sectors, whereas metals, banks and power underperformed. Performance of major global equity markets was weak. All major indices in US, Europe and major Asian markets delivered negative returns in the month. This was primarily on account of escalation of trade war tension between US and China, with both the countries raising the tariffs on goods imported from each other. During the month, BRENT crude prices corrected by approximately 7% and closed the month at $60.4 per barrel. Prices of most major commodities also corrected except gold and lead. During FYTD20, gold prices have risen by approximately 15% on back of safe haven demand. INR depreciated by 3.8% against USD and closed at 71.4, mainly on account of FPI outflows and general strengthening in USD against most other emerging market currencies. FPIs were net sellers in the month and sold equity of $2.5 billion in August. Total FPI's equity inflows in CYTD19 have been close to $6.8 billion. Net inflows in domestic equity-oriented mutual funds improved to 103 billion rupees in July 2019 from 57 billion rupees a month ago. For FYTD20 till July, total flows in domestic equity-oriented mutual fund stood at approximately 200 billion rupees. Given the slowing growth, government announced measures to boost the economy, of which major ones are highlighted below. Consolidation of major PSU banks announced. Front-loaded the recapitalization of public sector banks with 700 billion rupees as announced in budget. The surcharge on long-term and short-term capital gains on equity withdrawn. Housing finance companies to be granted 200 billion rupees of liquidity from National Housing Bank in addition to the 100 billion rupees already announced. All pending GST refunds to be refunded in 30 days and going forward will be processed in 60 days. Payments from central public sector enterprises and government departments will be expedited and monitored. Q1 FY20 results of cement, construction and media were better than expectations, whereas banks, healthcare, consumer staples and industrials were largely in line with the expectations. Results of IT, auto, consumer durables and metals were below expectations. Nifty 50 is trading at price to earnings multiple of 19x based on FY20 estimated earnings and 15.8x based on FY21 estimated earnings. These are reasonable multiples, especially in view of improving profit growth outlook. Markets thus hold promise over the medium to long term in our opinion. With the sharp decline in mid-caps and small-cap stocks over the past 15 to 18 months, significant divergence with large caps is not likely going forward. Adverse global events, rise in crude oil prices, sharp moderation in equity-oriented mutual funds flows, delays in NPA resolution under NCLT are key risks in the near term. It is worth noting that the gap between 10-year G-Sec and 1-year forward Nifty 50 earning yield has reduced significantly and it is now below 10-year average. This indicates that market is attractively priced. In view of the above and expected recovery in earnings, there is merit in increasing allocation to equities in a phased manner or in staying invested as the case may be for those with a medium to long-term view and in line with individual risk appetite. Debt market update, August 2019. The yield on 10-year benchmark G-Sec ended the month of August at 6.56%, up 19 basis points over the previous month end. Average interbanking liquidity continued to remain positive for the month due to higher central government spending and tepid growth in currency in circulation. During the month, RBI transferred surplus of 1,480 billion rupees, adjusted for interim dividend of 280 billion rupees, to government, including 526 billion rupees as write-back of excess provisions for earlier years. This should further improve the liquidity going forward. Net FII debt inflows improved to $1.6 billion during the month, compared to net inflows of $1.4 billion in July 2019. In the first 8 months of CY19, aggregate net FII debt inflows were close to $4.3 billion, as against outflows of $5.6 billion in the corresponding period a year ago. INR depreciated against USD during the month by 3.8% and ended the month at 71.4 on back of general strengthening in USD across major emerging market currencies. Slowing domestic economic activity and FII outflows from equity markets. Annual rate of retail inflation, CPI, was largely stable at 3.15% in July 2019, down 3 basis points month on month. Food inflation was largely unchanged compared to last month. Fuel inflation fell compared to previous month due to lower LPG and diesel prices. The fall in fuel prices was largely offset by higher core CPI. CPI excluding food, fuel, transportation and housing, which inched up on month-on-month basis to 5.07%, up from 4.74% a month ago on account of uptick in personal effects as well as high education and health services inflation. India's trade deficit for July 2019 fell to $13.4 billion, primarily on account of fall in net oil and gold imports. Increase in oil exports was on account of few refineries restarting their operations after being partially shut down for maintenance a month before. Ex of oil and gold, the trade deficit increased due to higher imports of engineering and agriculture products, along with lower exports of transport equipments. India's gross domestic product (GDP) growth moderated to 5% year-on-year in Q1 FY20 from 5.8% in Q4 FY19, led by sharp slowdown in private consumption as well as weak investments growth. Growth in exports was also weak, but was set off by weak imports. Growth in gross value added (GVA) also slowed to 4.9% in Q1 FY20 from 5.7% a quarter ago, primarily led by slowdown in industry, especially in the manufacturing segment. Growth figures were partially impacted by high base effect. GST collection for the month of August 2019 stood to 982 billion rupees, largely flat as compared to FY19 average monthly collection and up approximately 4.5% year-on-year. The average monthly collection required to meet the budgeted target for FY20 is estimated to be around 1,050 to 1,100 billion rupees per month. Outlook: RBI dividend, including write-back, of 1,480 billion rupees was higher than budgeted estimate of 900 billion rupees and thus came in as a positive surprise. This additional dividend should reduce the expected shortfall in revenue to a certain extent and ease concern on fiscal worries. Also, this might result in lower than anticipated open market operations purchases from RBI for FY20. With the accommodative stance of RBI and weak GDP data, there is some scope for policy rates to fall further by another 25 basis points to 50 basis points. However, given the recent rally in G-Sec yields, scope of significant fall in yields remains limited in our opinion. On the positive side, factors such as range-bound oil prices, should ease pressure on CAD. High real yields in India, softening global commodity prices, easing stance by major global central banks, trade war tensions, and moderation of global growth favor lower interest rates. However, in our opinion, most of the positives are largely factored in and thus yields may not fall significantly from here on. Further factors such as 1. Excess statutory liquidity ratio within banking system. 2. Optimistic revenue assumptions as well as fiscal stimulus, if announced, posing risk of fiscal slippage. 3. Risk of INR depreciation, which appears overvalued on real effective exchange rate basis. Expected cyclical recovery in H2 FY20, supported by measures taken by RBI and government, etc., might impact the yields adversely. Hence, going forward, though there is scope of policy rates to fall further, yields are likely to remain range-bound, albeit might trade with a downward bias. Considering the aforesaid factors, in our assessment, the short to medium end of the yield curve offers better risk-adjusted returns. Hence, we continue to recommend investment in short to medium duration debt funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.